The US is not going into recession at all. But the original tariff announcement I didn't see as being as economically damaging as consensus. The one thing I didn't get right was that I didn't see the outperformance of the European equity markets. But other than that, I think on the whole, my calls at the start of the year have panned out pretty well. And I wouldn't change very much at all, actually. If I was refreshing all of those calls, I would pretty much say the same thing about economics, about markets, about yields.
So Neil, back in January, you were relatively optimistic about the UK and cautious on parts of the global market. You expected UK growth to pick up through 2025 and 2026, helped by falling inflation, rising real wages and increased government spending. You also forecast 4 rate cuts this year, with the base rate dropping below 4%, and felt official GDP data was understating real momentum. You anticipated a short-term spike in inflation earlier in the year, but expected it to fall back towards the 2% target by year-end. And if I may say so, you were bullish on UK equities, predicting the FTSE 100 would outperform the S&P 500 with falling rates and improving sentiment driving a re-rating. Globally, you expressed concerns about US tech valuations and saw more compelling opportunities in the Asian markets, including a potential recovery in the Hang Seng. And on trade, particularly the proposed US tariffs, you saw them as aggressive opening moves, especially from Trump, but expected other countries, especially China, to ultimately negotiate towards more constructive outcomes. So let's start with the bigger picture. What's changed since January?
It seems like a huge amount has happened. We're only really in the 5th month of the year, but it feels like we've already done 12. It feels like a marathon, frankly, because there's been so much going on. Of course, Trump ascended to the US presidency in January and got going straight away. And we've seen a whole raft of announcements, probably the most significant being the tariff announcements, which completely undermined market sentiment globally for a while, but since that's bounced back. So it feels like a lot's happened, but if I was to refresh all those things that I said back in January, I wouldn't really change very much at all, actually. I've managed to call most things that happened. The one thing I didn't get right was that I didn't see the outperformance of the European equity markets, which have performed pretty well this year. But other than that, I think on the whole, my calls at the start of the year have panned out pretty well. And I wouldn't change very much at all, actually. If I was refreshing all of those calls, I would pretty much say the same thing about economics, about markets, about yields. So if just to quickly refresh, the US is not going into recession at all. I think it'll grow something like 1.5%. It'll be slower than last year, but it will not go into recession. The tariff announcement, the original tariff announcement, I didn't see as being as economically damaging as consensus. And of course, we've moved on a long way from that original statement on the 2nd of April. We're already in a process of negotiation, most importantly, of course, with China. We've got a 90-day reprieve there, and I expect a more positive outcome to those discussions. So anyway, as far as the US, I still think the US economy will grow something like 1.5%. China is a more challenged economy. Growth is going to be harder to come by, albeit that the official target is 5%. But it's clear that the administration is concerned about growth and is starting to do the right things now. So importantly, Xi Jinping's government is stimulating now in a way that it probably hasn't for years. So there's very targeted stimulus directed at increasing domestic consumption, basically, in China, and that's the key. We want to see more of that, and I think we will see more of that. So I'm a little bit concerned about the domestic Chinese economy, but the most recent data sort of confirms really what I've been thinking all along, which is manufacturing output has been very strong. Consumption growth is a bit weaker, so that sort of plays into what I've just said about stimulus.
With China, are we still seeing opportunities there?
Yes, we are, definitely. I think even though the economy is more challenged probably than it's been for a while, I still think that the undervaluation of the leading Chinese equities, particularly tech equities, and in the EV sector, is still profound. And I still think there are some really exciting opportunities in the Chinese equity market.
Turning into the UK, how would you categorise what's happened here?
Pretty much has played out as I had thought. In fact, where I am surprised is at the strength of growth in the first quarter. Even I hadn't called 0.7% growth in the first quarter. I think that surprised quite a lot of people, particularly MPC and the OBR, who had much weaker forecasts in place for Q1. Inflation has played broadly as I thought, and I still believe that inflation will peak at a much lower level than the MPC and the OBR, so I'm not worried about where inflation is going to be. We're going to see the April number produced relatively soon. That will mark, I think, a short-term peak in inflation, and inflation will fall from that level. And I don't see another peak in July. In fact, I see inflation coming down pretty much from that April peak. So inflation is behaving itself. We've seen two cuts in interest rates this year, and I think we'll see more. Broadly, the economy has behaved as I thought it would. As I said, a bit stronger in Q1 than I thought. I'm still confident that my 1.5% for this year, 2% for next year, is on track. And if anything, if I was going to correct that forecast, I would argue for higher growth rather than lower growth.
Are these, if we take a step back, are these global trends emerging between the China, US, and the UK? Is that what we're looking at?
There are global influences, of course. I mean, trade is very important, particularly to the US and the Chinese economy. But the UK really has the economic story for the UK is very domestically driven. Trade I don't see as either being particularly positive or negative for the UK economy currently. The trade data, in fact, in the UK, I've written about this on a number of occasions, the trade data is incredibly volatile. We're not, I think, recording, or the ONS isn't recording the UK's trade performance accurately at the moment. I think the ONS has finally had to put its hand up, frankly, and there is now a process of re-evaluating a lot of what the ONS is producing. And I think there's a widespread recognition now that the ONS is getting quite a few things wrong. But I don't, coming back to the trade point, despite the volatility, I don't really see trade either being a big benefit or a headwind for the UK economy. The thing that will drive the UK economy is domestic consumption growth and government spending growth this year. And what will drive that higher level of consumption growth is lower rates, lower saving, higher spending.
And to counter that, are there any risks on the radar?
There are always things that sort of could come from left field to upset the economy. But my sense is the risk factors that the UK's confronted over the last 2 or 3 years, when you go back even longer, I mean, if you include COVID, of course, this economy, the global economy, has navigated through some really testing times in the last 5 years. COVID was a massive challenge. The war in Ukraine was a massive challenge because of what it did to energy prices. And my guess is that weirdly we're actually in a sort of period of economic and socio-economic calm, which may sound odd in the context of Trump's tariff announcements and the toing and froing. But my sense is that when I look around the world for potential flashpoints, I'm struggling to see them. Now that may well be a naive view. I mean, there are, people have written to me in the past about what might happen in Taiwan, for example, or other global conflagrations. But my guess is, with Trump at the tiller, if you like, in control, he's keen to leave his mark. He's a man in a hurry, and so I've always believed that the trade situation would be resolved satisfactorily for the global economy. have believed for a long time that he wants to see a peace settlement in Ukraine, between Ukraine and Russia. And my guess is that when he intervenes, that he will get the outcome that he wants. Now, whether that's the greatest outcome for Ukraine or Russia, I'm not sure, but nevertheless, no war is better than war if you're looking at the context of what's the best environment for global equities.
And would you say then for long-term investors who are trying to make sense of this environment, would you say then it's largely positive at the moment?
Yes, I would. Of course, always, if the economic backdrop is supportive for equities, that's a big tick in the box, and I think it generally is. I said at the start of the year, one of the key driving forces globally would be lower interest rates, lower inflation, lower interest rates. That would provide a support for government bond markets, and it would support equities, and I still believe that. The Fed, I think, is being a bit cautious because it wants to see what's going to happen with the tariffs. But having said that, I remain completely persuaded that essentially that inflation is falling everywhere globally.
Okay.
Interest rates are on their way down. That is a positive macroeconomic environment for equities. But it doesn't mean that all equity markets go up. And I still would caution investors in exactly the same way as I said at the start of the year, which is overvalued markets, and particularly the US, which after a sort of very big fall and a big rally, is still to me looking an overvalued market.
Okay.
So I would still caution investors about that, the outlook for that market. But I think the markets that I was more positive about at the start of the year, I'm very much positive about now too.
So where are investors focusing their attention now then?
Well, global investors, I think, if you're looking for equity opportunities globally, in the last 6 months I've been calling out the UK and China and Hong Kong really as areas that I would favour. European equities have performed well this year, but I don't believe the valuation arguments for European equities are particularly compelling.
Okay.
And I would still caution people about the US equity market. Having said that, there are always opportunities in specific sectors or in individual companies, even in markets that are overvalued. So I still think there are some really exciting opportunities in Europe and in North America. From an overall market view, I still favour China, Hong Kong, UK. And the other asset class that I was more positive about, it's unusual for me to make a call really about fixed interest markets, but given where UK bond yields were at the start of the year, up near 4.9% 10-year yield, I said that was way too high. It's that high because we've got very high base rates, and I said with lower inflation we'll see rates falling and the bond yield will follow base rates down, and I would still advocate that. So I think 10-year bond yields are still a good buy now with a 4.6% yield.
If we're looking at the US, has the market played out how you anticipated?
Despite the overvaluation in the US equity market, I have consistently said do not expect some sort of market meltdown. There's not. In my view, there is not a need, or neither are there the circumstances there for a significant market correction. So some sort of 25% or more sort of correction, a very very sharp nasty fall. Didn't see that happening. What I do see happening is that the US over a period of years just underperforms global indices as valuation corrects. Now, broadly, I would still subscribe to that view. Of course, in the intervening period, we've seen a full-blown market panic. It wasn't that severe, but a full-blown market panic around Trump's tariffs, and then a very, very rapid rally. So the US market is actually now up about 1% year to date. So having got there via a big fall and a big rally. From here on, I don't expect to see the US really change that significantly. So I'm still of the view that the US equity market will gradually underperform over a period of years.
So with this kind of mixed economic data, we've seen policy shifts, as you mentioned, and this continued volatility. Where are we now, and what's your outlook for the rest of the year?
I continue to believe the UK equity market will outperform. I think there's a lot of upside in the UK equity market. and in particular, I think those domestic sectors, those sectors that have been ignored, neglected, and have performed very poorly for years and years, those I think will lead the UK market higher, and I expect the UK to outperform the global index. I still am very positive about Hong Kong, China. I think the valuation support for those markets is very attractive and very strong. And if you like, the catalyst, I mean, I'm not a great believer in investing because you believe there's a catalyst around the corner. But for me, the Chinese administration is going to continue to bring forward policy stimulus, and I think the market will respond positively to domestic policy stimulus. So I still think that market is well set fair. As far as Europe is concerned, you've got to hand it to the ECB. The ECB have been very aggressive with rate cuts. They've got rates now down at 2.25%, which is way lower than they are in the UK. And I think they've done all they can really to help the domestic EU economy. Germany's still very challenged, of course. France is growing very slowly too. So, Europe has got a lot of problems, a lot of economic challenges. I don't see those sort of falling away anytime soon. So the macro backdrop for Europe still looks to me to be pretty difficult. The equity market has had a very good start to the year, but I don't think there's enough valuation attraction to sort of drive it on. So really, from my point of view, I would, if I was exposed to European equities, I would sort of congratulate myself and maybe bank a bit of profit, because I don't think it's going to continue to perform as well as it has in the first 6 months of the year. I think there will be one or two more rate cuts, but we're getting close to the end of that rate cutting cycle, whereas in the UK, we're broadly at the start of the rate cutting cycle.
Well, that's what I was going to ask you specifically about the UK. What's your view on our growth, inflation, policy direction, kind of heading towards the end of the year?
I'm not a bull of the UK's policy backdrop. I think the UK government that's will in July have been there only for 12 months has really not done a terribly good job. The budget was a mistake last October, a big mistake, and I think a huge missed opportunity, frankly. I think the OBR and the MPC, who guide fiscal and monetary policy, are still structurally way too pessimistic on growth in the UK, way too structurally pessimistic on inflation. Their models aren't working, their forecasts are all over the place, and they're wrong, frankly, pretty much about everything at the moment. It's not really surprising when you've got the rate setting committee that have got an economic model that's not really giving them the right answers. And you've got a chancellor who's relying on an OBR model that's spewing out, I think, complete rubbish, frankly. And it doesn't surprise me, therefore, that to some extent we've got the wrong policy settings, which I think we have. We've got fiscal policy, which is going in the wrong direction, and we've got monetary policy. We've basically got way too high rates, and rates should have been coming down more aggressively for longer. And I think they should continue to come down probably more aggressively than we're likely to see this year. But having said that, I don't think these sort of suboptimal policy settings are enough to derail the economy. In fact, I think the economy will be doing well despite the headwinds of higher rates than we need and a tighter fiscal policy environment than we need. Consequently, I'm still very confident that the UK economy will perform well despite the sort of backdrop that we've got right now.
So these kind of signals and pressures that you've mentioned, are they something that investors should be paying attention to?
Yeah, investors should always be aware of these changes in policy or how policy evolves. But they should also equally be aware that consensus is often wrong. Okay. And particularly in the UK. I think consensus has increasingly, over the last 10, 15 years, become increasingly pessimistic about the outlook for the UK economy, increasingly pessimistic about the outlook for the UK equity market. And we seem to be locked into this sort of doom loop. The UK equities can never perform. The UK equity market is somehow has become detached from its history or from other global markets and should be seen as some sort of basket case. The UK economy is sort of predestined to sort of never perform well. That sort of lazy consensus view is wrong. I think the UK economy will be one of the best performing in the G7 this year. I think the UK equity market is going to perform very well and for very good reasons. And I think we're set fair.
I'd love to know then, as we head towards the end of the year, what are you watching closely?
I sort of described the fund manager's role as sort of being, if you like, the analogy is you're on, I don't know, maybe the bridge of a warship or something, and you've got many inputs. You've got weather inputs, you've got enemy ship inputs, you've got all sorts of other things. You've got a whole load of information. You're looking out to try and anticipate the environment that you're going to be sailing into. And a fund manager's job, or somebody who's following markets, or a private investor's job, is to be aware of all those things that are going to have an impact on their portfolios, and not to react to them. Importantly, not to react to every input but to try and understand everything that changes, everything that's really important that changes. More often than not, actually, the change can be assimilated, understood, and factored into thinking, but it shouldn't result in any change to portfolios. So much information that comes in is sort of important in that it reinforces probably if you've got your view right, it should reinforce your confidence in what you've already done. I think way too many fund managers, way too many investors are too reactive. My mantra is don't just do something, sit there often. And don't be reactive. Don't have your hand, if you like, or your finger on a hair trigger. Assimilate information, understand it, factor it into your thinking. But 9 times out of 10, it won't and shouldn't change anything.
Does that come from instinct or working?
I think it comes from, I suppose, a lot of experience. Having witnessed markets now for the best part of 35 years, I've sort of seen a lot of things come and go. I've learned a lot from the mistakes I've made. I've learned a lot from the mistakes of others. And I've also read quite a lot about from people who I believe really understood fund management. People like Warren Buffett, for example, who stepped down a couple of weeks ago at the age of 92. I think he describes the fund manager's job probably better than anybody. And I think it's important when you have a long-term investment perspective, when you understand what you're trying to achieve, when you understand what your long-term goals should be and should be, then you will naturally become less reflexive, if you like. You're less manic about all the chops and changes that happen on that journey to a long-term attractive investment return.
Just moving then on to the UK equity market. You've said that it's absurdly cheap and mispriced compared to global peers. But we've yet to see any real international capital flows back into the UK. What, realistically, could be the catalyst for a sustained re-rating, or do you think the discount is now permanent?
Okay, let me take that in reverse. I don't think the discount is permanent. It feels permanent because the UK equity market has underperformed for so long. And the valuation compression that's been going on in the UK has been a long-term phenomenon. But largely the headwind that the UK equity market has had to confront is that the large institutional investors that ought to be the sorts of institutions that own the UK equity market, who did own the UK equity market 25 years ago, have basically sold all of their UK exposure. That has been a massive headwind for the UK equity market for 2 decades. I've got some amazing data, which I saw in an article I read last week, which highlights this challenge and highlights the unusual status that the UK, and the unenviable and unusual status of the UK equity market, where its domestic investing institutions have virtually no exposure to their own equity market, and yet in pretty much every other G7 country, domestic investing institutions are substantially overweight in their own domestic equity market. We're an outlier. We are very unusual. Nevertheless, we are where we are. We've been through 2 decades of dramatic underperformance that has driven the market down to an incredibly low valuation. And everybody's very depressed about UK equities. It's very unusual to find anybody who's bullish about it. And that, in a way, is what makes it interesting, very interesting. But I think valuation is the key determinant of future equity return. And it is clear that UK equities have become totally detached from other global equity markets, both in terms of the history, in terms of the rating of the UK equity market, and in terms of international peer markets. UK equities are trading at a massive discount, rivaling only really what's happened in China very recently. And those valuations are just not justified. They're not justified by return on capital. They're not justified by the quality of the businesses, by the management, by the forecast that I see in terms of revenue and earnings growth. And so I do see that market correcting. I don't see it correcting overnight, but I do see it correcting over a period of time, back to a more normal valuation. And you don't have to think that the UK equity market will achieve its sort of peak valuations in recent history, or some years before. But you just have to believe that the UK equity market will start to be valued like a normal developed economy, properly functioning UK equity market, or equity market, sorry. And if that is what you think will happen, then the UK will continue to perform well for some years to come.